Hey everybody, this is Alex Merced from alexmerced.com. And I was just listening to a recent NPR economics podcast, and what they did is they were interviewing this author of a new book called Capital in the 21st Century. And basically the thesis of the book, which I have not read yet, so I'm not quite familiar with every argument made in the book, so of course some of the things I may mention may be addressed in the book, so go out and read it. But the basic thesis of the book is when you have an economic environment where the return on capital is greater than the economy is growing as a whole, the natural result is that you're going to have growing inequality, which I kind of agree with actually. Um, okay, and this is kind of how he explains growing inequality in the U.S. starting in the 1970s. My first reaction though is that this is very consistent with something that I've been saying, and I think other libertarians have been getting at for a very long time. Okay, so the reason why is because generally that it's the money supply, or it's the monetary system stupid. Okay, because if you have an inflationary environment, okay, like one where it's not even pernicious inflation, where in the sense where you have this inflation that just seems really bad and it's right in your face, but even a light amount of inflation, what's going on? Inflation, which is again and I'm using inflation as in the term of increasing the money supply, um, which results in increasing prices. Okay, it's going to increase the return of the capital. Why? Because if you devalue the currency, that means the price of all other assets going up, particularly like stocks, bonds, real estate, capital. Okay? And it devalues wages. Now, if you take a look at most people's wealth is not tied up in assets like houses, stocks, and bonds, which are good things to have. Um, but they're tied up in wages. Most people don't invest and hold capital, they have wages. So if you have an environment that's steadily eroding wages and steadily rewarding capital accumulation, then the few who accumulate capital are going to enjoy the returns, and the vast majority who live off wages are going to see that they're constantly falling behind. Okay, so keeping that in mind, when did we really start, see that happen? The 1970s. That's technically right around when the Bretton Woods system ended. Okay, and with the end of the Bretton Woods system, that sort of unshackled what kept sort of inflation in check, and thus growing inflation, which in the 70s and in even a portion of the 80s was quite high. Okay, so which would kickstart that whole process of again increasing returns to capital, decreasing returns to wages, thus creating a more unequal society. Okay, and again, I don't know if exactly in the book do they point this out. I have a feeling that they won't. Um, Usually, people who kind of get at this usually go in the route of saying, "Oh well, then we need to tax capital and have social safety nets and stuff like that." When you could easily just end the cause of it, the inflation. Okay, so this is why you had less inequality when you had a more sounder monetary system. Now, this is not me advocating for a return to Bretton Woods. This is not me even advocating for a return to the classical gold standard of the late 1800s, early 1900s, because both of those systems had flaws. Okay, some of those flaws were political flaws. Okay, and some of those flaws were economic flaws. Okay, that would have been problematic either way. What I'm advocating is more of a free market in money, competing currencies. So again, expanding the cryptocurrency market and other currency alternatives. The reason is the more diversity we have in our mediums of exchange, the easier it is to preserve the value of your wages. So for example, if you have more Bitcoin becomes more used and people start, let's say, having wages in Bitcoin, well, your wages in Bitcoin, due to the nature of Bitcoin, will probably have a return, okay, versus your wages in dollars. Also, the fact if Bitcoin were to become more prominent, it would put pressure on the Fed to not inflate as much. Okay, same thing if you had a more robust currency market in general, or even a dual currency market. Okay, that was one thing I advocated once before, where if you can't find if there isn't the political strength to have a free market in money, at least have a instead of one centrally managed currency, have a dual currency system. So where basically you have sort of a gold back money and then your fiat money, sort of both with the same issuer, and allowing people to diversify their monetary holdings, their wages, etc. You can refer to my older videos on that suggestion. Okay, but basically, what I'm saying, I'm not sure if this exact description of how inequality happens has been described by somebody else. I don't remember hearing it before in the exact terms that I put it in. Essentially, again, emphasizing how inflation increases returns to capital, decreases returns to wages, thus creating a equality gap, which makes perfect sense since the inequality started growing in the 1970s, just as the U.S. goes off the Bretton Woods system. Okay, so and then yeah, that actually I think that kind of nails it on the head. So in that case, I'm looking forward to getting a copy of this book and reading it to see if maybe he goes in that direction, or maybe he goes into the typical direction of advocating taxes on capital and social safety nets and whatnot instead of addressing the core problem. But interesting new data and new research on which could enhance the libertarian position far as addressing the problems with monetary policy and a lack of a free market in money. So my name's Alex Merced from alexmerced.com. Have a great day and enjoy.